The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, I'm Esther Gulius, the tax lady on Ask the Tax Lady, and we answer your tax questions. We keep you abreast of everything that's going on in the lovely world of taxes. And let's face it, it being September, we have September, October, November, December, like a little less than 4 months to get everything together here so that you pay the least amount of taxes and you know about all the deductibility of everything relative to your tax situation. And that's what we do here every Saturday from 3 to 4. And I've joined in studio here with Christopher Fabian. Hey, Chris.
Hello, Esther.
Hello, Christopher. And Tiffany Fabian.
Hey there, Esther. How is
Tiff.
it going?
I'm happy. I'm happy. You know, it's hard to believe that it's now back to school, isn't it?
Yep, school already started, and
well, so back to school is at EG Tax.
I was going
right?
to say school started for little kids, now for adults.
Right. So tell everybody about that.
Sure. So our tax class starts October 13th, and it meets twice a week, either in the mornings or evenings, whatever is more convenient for you. There's also an online version if you don't want to, as Esther would say, get out of your PJs. It's free of charge. You do, however, have to purchase the book and the workbook. And our hope is that you will come work at one of our 31 offices. So that's the intent, and it's a great opportunity.
It's like an entry-level position. It's wonderful because, you know, when you're an enrolled agent, basically you have the right to practice before the Internal Revenue Service. It's a lot like being a CPA. And we actually put our employees through usually, if you're really fast, you do it in 4 years, but we don't charge for any of it. So you could end up getting a degree in enrolled agents certification from the Internal Revenue Service, and that's part of what we do when you attend our school. So you have our basic, our advanced basic, our advanced, and then our enrolled agents classes. And so if you think that if you're maybe just recently retired and you say, oh, the winter is so long, we got a way to make the winter not long at all.
Yeah,
right?
We really
work.
work. I mean, it's
right. I mean, and it's so wonderful because you meet all these great people, you get to serve them. And that's what we love to do.
Absolutely.
Right?
I mean, and the weather.
And so how would people
yucky.
register, you guys?
Sure, they would go online and click on Tax School and register online, or they can
just register online anywhere, or should they go to egtax.com?
They should go to egtax.com. Yep, good point. Excellent point. Go to egtax.com and click on taxes, learn about taxes, register that way, or call 632-7886, and we could register you over the phone or email you a registration form.
And if you're an experienced tax accountant and you're looking for a new place to maybe hang your shingle, EG Tax would love to interview you because we are looking for great experienced people at the same time. And again, you would be able to register for one of our advanced classes.
Right. Or maybe, if you're, how about a retiree from the IRS and you want to work on the other side of the fence, you know?
We have people who have done that.
Yep, and they love it.
Yep. Okay. And normally we have you call in and we answer your tax questions, but about 4 or 5 times a year, we just do a Saturday devoted to your email questions. And it's kind of cool. I really enjoy these kind of things because you get to hear us think about taxes because we have an opportunity to really chew up the answers. So why don't we see what we have here? And so this week, no live phone-ins. Next week we'll be back taking phone calls, but this week we're going to just do emails. So what do we have to start off with, guys?
I have Esther. I heard that I have to divulge my husband's income to my employer. Is this something new? What's happening? Do I have to comply?
Well, this is, with the tax changes and new tax forms came a new W-4. And if you read the booklet with the W-4, and how we always all got confused with the worksheet that used to be attached to the W-4. And for those who are going, what the heck is a W-4? That's your withholding statement to your employer.
That's the thing that directs the employer to withhold taxes.
Correct. How much to withhold.
Right.
And so the IRS is trying to do it where you keep most of your money in your pocket instead of giving it to them.
Which is a very wise thing.
Right. So their new worksheets say, how much do you make? Do you have another part-time job? Do you have another job? Are you married? How much does your husband make? How much is the withholdings? So they're trying to help you maximize your own paycheck.
But again, you really don't divulge it to the employer. It's just on the worksheet. The form you actually submit, the W-4 itself, just tells the employer how many allowances to claim.
Correct.
Right. So it's not. So when you're doing the worksheet, obviously you have to, and you should have done this all along when you were doing it before. You really combined, if you're filing a joint return, both incomes, all credits and children and withholding, and based upon the amount of tax liability that you're going to have and how much your spouse is having withheld, you'll be able to see how much you should have withheld.
Right. And you know what? This could be a good thing because it means the spouses actually have to talk to each other about their withholdings. Yep. Because how many times do we see where a married couple comes in and they're both claiming 4 and then they end up owing a lot of money and they go, we don't understand why.
Or one is claiming 6 and the other one is doing 0, and that's another problem.
So if you're having trouble, because it's really like reading Sanskrit a lot of times, you can call EG Tax at 632-7886 anytime, and we'll be happy to work with you on your W-4. And what we put into the equation is, okay, so it says that you should have $100 a week withheld and claim 4 allowances, let's say, for instance. And when we talk to you, you say, gee, I don't think I want to be that tight. Maybe I'd like to claim 3 because I'd like a little refund. And so that's something that we can put into the mix that maybe when you're sitting home, you wouldn't know what to do with.
Yeah,
correct.
Absolutely.
Right?
Yep.
Okay. What else we got?
Okay. Marty from Lancaster. Tax lady and crew, my wife and I pretty much live off of Social Security, which totals around $25,000 per year. We are age 67 and are worried about collecting our RMDs on the IRAs. We have about $300,000 between the two of us. Should we just transfer this money into a Roth?
Okay. A lot of people, don't you have people that call and say, I got all this money in a traditional IRA and I don't want to pay taxes when I have to do my RMD, so I'm going to just pay all the taxes up front, right? I actually hear investment advisors say that. Well, first of all, on $25,000, right?
Right.
In Social Security, and their RMD on the $300,000 is going to be less than $10,000.
It's about $11,000. Yep.
Right.
Yep.
So how much of that $11,000, if they take their RMDs out with their $25,000 in Social Security, is going to be taxable?
I'm chomping at the bit. Nada, zero, zilch,
Zero.
nothing.
Right. So if they just wait for their RMDs to come through, they will pay 0 in taxes. But if they are tempted because they hear these people talk about moving this money over to a Roth, approximately what would they pay in taxes?
If they move the whole $300,000? Oh my gosh.
Around $45,000, $50,000. Right?
Easily.
Right?
Yep. And not to mention New York State.
Yeah. I mean, so don't listen to people. Always call. You can call EG Tax. We don't charge you. We want to help. It actually hurts us when we see people do things like that. So if you just do your RMDs, you're going to find out that you pay very little in taxes or none at all. If you transfer that money over to a Roth, you're going to have to pay the taxes up front. And it'll be at least $45,000 to $50,000 plus New York State.
And Esther, a lot of people have room. They have room to even take more out of their IRAs. And
well, and this couple would too.
Yep. And so that's something you want to look at.
So as a matter of fact, and that's a great point, Tiffany. In this situation, even though the RMD, the required minimum distribution would be around $11,000, they could actually take more out and still pay zero taxes.
Yeah,
Right.
That's right. And I think we got to go to a break soon.
We got to take a little break. I'm Esther Gilius, the tax lady. We're here talking about your emails. We're going to take a short break. We'll be back on the other side. Hi, I'm Esther Gilius, the tax lady from EG Tax. Today we are not taking live phone calls. Next week we will. We're chewing up your emails. Don't forget, if you're interested in tax school, you can register online at our website at egtax.com. And I'm here in studio with Tiffany Fabian, Christopher Fabian, and we got emails to talk about. So what's the next one, Chris? or Tiff?
Sorry, Esther, I was audited 2 years ago, and since I could not find most of my receipts for my outside sales job, they backed away almost everything except for my mileage. Recently, I found a box during our move that had all of the receipts. Is there anything that I can do to recoup the money? And that's
So it all
file an
depends on
audit
how long ago did he pay the liability.
Yep. He's
No, actually, they
Audit
could do an audit reconsideration.
Well, that's true too.
Yep. Before you even, because that's what you could do the amended return, but you should do an audit reconsideration where you send in your proof saying, look, I didn't supply this. I now have everything. Can you please reopen this case? And
All right, but what is their criteria? Do they just do it for anybody at any time, no matter how many years have gone by?
yes, yep. And that's what you hear on these TV and radio commercials, how these people have saved all their taxpayers' money because of audits, and that's what they do. They reopen an audit, and they just take care of. They do an audit. Here's all the new stuff, the stuff that you didn't see before. We want to present it now.
Esther, oops, sorry for stepping on you. I met with a client yesterday, and he owes upwards of $100,000 to the IRS, and he pays $1,500 a month, and he said it's just the interest, and he feels like he's getting nowhere. And so we called the IRS, and in 13 and 14, he was audited, but he didn't know he was audited, and they
Because he hadn't filed his returns?
No, he was audited. He just didn't remember.
And he didn't know? How did he not know?
He didn't know. He really didn't know. He's
Okay.
I mean,
And
he
what
was,
happened?
And so what happened is we asked for his transcripts, and I'm going to look to see if we can do an audit reconsideration. It had to do with his itemized deductions, and there was a divorce situation, paying mortgage and property taxes on the ex-wife's house. His name was still on it, so I'm hopeful that we can do a reconsideration, and it'll be a positive
But here's
result.
the thing, which is so strange because it's hard to believe that this guy would not have been aware of the fact that he was being audited. But if that's your situation, and you find that all of a sudden you're getting a bill in the mail and you don't understand why you have a bill, don't pay it. And obviously, if they seize your bank account, give us a call as well. I mean, because oftentimes what happens is maybe somebody moved, maybe the bill was going to his ex-wife and she said, I'm not going to tell Charlie he's getting audited. I mean, there's all kinds of situations. And when you explain it to the IRS, things like the audit reconsideration can be done and open up that audit. And so if you're paying past due bills due to an audit and you can find the proof, or you didn't know about it, or maybe you do owe it and you don't have the assets, you can do an offer in compromise too, right, Tiff?
Yep, you can do an offer in compromise. That's when you hear those commercials where you pay pennies on the dollar. An offer in compromise is a potential if there is doubt to collectability. So the IRS will say you'll owe $90,000, and you'll say I could pay $1,000, and maybe they'll come back and say how about $2,000. But again, it has to be, you have to supply 3 months of your electric
But
bills.
if you
3
can
months.
pay, they're going to make you pay.
Right, doubt to
right?
collectability.
And the whole thing is it's doubt to collectability.
Yep.
I had a lady the other day that said to me, I just hate it that people get away with this kind of stuff. And really, it's interesting. In our whole society, everything panders to people that are less competent, right? People that make less money, people that are having problems with how they're able to fit into society. So society kind of bends the rules for those people because they're having a problem or made some bad decisions. And that's what's in the tax code. We have social services for people that maybe have fallen through the cracks or unable to get a good job. Maybe somebody's addicted to drugs. And in the tax code, if you made a big mistake and you're unable to pay and they're taking out $30 a week out of your $100 salary and you think, wow, I'm never going to get out from under, there is a way to get out from under.
Right, right, and they help. I mean, it's the same with bankruptcy. The IRS has their own version. It's the offer and compromise. So
Right.
it's not just. We've seen people who do make $100,000, $150,000 that got an offer accepted because their house is underwater. Not literally, but financially.
If you're on Lake Ontario, your house might be underwater.
Or in a hurricane zone.
Right.
But they are willing to work with anybody out there, and you just have to prove it, and they'll work with you.
Okay, what else we got here?
Our 19-year-old daughter has given us an unexpected grandchild. She is single and lives with us. She has decided to go back to college so she can make the most of this time with the baby. My wife and I both work and make around $100,000. Will the baby save us money? Can we claim our daughter? Our daughter did work in 2019 before the baby came and made under $1,000. Is that money taxable to us?
Okay, so there's a lot of questions there. So since the daughter was not a full-time student and was over the age of 18, then technically she would not be a qualified relative of this person unless she made less than $3,500, which she did. Right. So she is the qualified qualified individual for this taxpayer. So they would get $500 credit for their daughter, right? And the grandchild would be what?
Would be, as long as the daughter agrees, it would be the dependent, of the mom and dad, her grandparents.
And the grandparents would then get a
child tax
what kind
credit,
of a credit?
A child tax credit.
$2,000.
A $2,000 credit. So now the daughter saves them $500, the baby saves them $2,000. Correct?
Yeah.
Right.
Now, what happens to mom's $1,000 grandma? Well, it's mom actually. Mom's $1,000 that she made working. Who has to claim that?
The daughter does. She does her own tax return and indicates that she was a dependent on somebody else's return. Now, she's underneath the filing requirements, but she probably still wants to file because they probably
She probably
did
has some
withholding.
little bit of withholding.
Yeah.
Now, what kind of messes up this thing is if the daughter who had the baby really decided that she wanted to claim the baby as her child, she would qualify for the earned income credit, right?
That's right.
Right.
And so what happens to grandma and grandpa in that case?
Then grandma and grandpa lose $2,500, and the mom gets about $100.
Right. And so that's what can happen. So I always think the best way to do the tax return is for all interested parties in the room together, so that the daughter with the baby sees that, yes, she's going to get the earned income credit, but her income is so low that the earned income credit's very small.
Yeah.
So all the girl would get is about maybe $150, $200 in refund. But if grandma and grandpa claims she and her baby, grandma and grandpa, are ahead by like $2,500 on the federal and also on New York State.
Another
right?
thing is, I was doing a tax return late last night, and one of my clients, how many times they listened to our radio show, and you said, if you got those W-2s for the kids stuffed in your drawer, bring them in. So I did their 15 and 18 returns for her kids, and then along
How much
with,
did they get to?
They got $200 and $150. But what I want to say is,
But that's $350.
what I want to say is, along with the W-2, she had the tuition statement, and I didn't do the mom's return because she couldn't get in with me, but the tuition statement. So I amended mom's return too, and she got $800 from the federal and $200 from the state. So how many times do you see mom and dad stick the tuition thing with their W-2s?
Yep. So let's linger on that point again. Even though you don't have to file a tax return if you make less than $12,000 on the federal, you still want to file the tax return because you get a full refund of any any federal withholding that you had. And so even if your parents, if you're claiming your child and they maybe made $6,000 working part-time at the university while the kid was in school last year, does the kid have to file? No. Does he want to file? Yes, because he's going to get, or she's going to get, a full refund of the whole withholding that they had, except for the FICA. So you want to make sure that you just don't throw those W-2s in your file folder. You want to file the return.
And can I muddy the water even more?
Sure, Chris.
I know you hate when I do this, but what's a part of, I know there's another email about this, but what's another part of tax law that we thought never would ever hit taxes? Health insurance.
Right.
If the daughter goes out and gets Medicaid for her and her daughter, mom and dad, grandparents, cannot claim her because then she would lose the Medicaid.
That's true.
So
That
you
is true.
really have to look at not just the income and the schooling and all that. You have to look at the health insurance side too, because you could still have mom and dad claim the daughter and the granddaughter.
But in this case, the daughter's 19, so she would qualify to be on her parents'
Till,
health
right,
insurance.
and that's why I was going to say till 26. But then
Right.
it's the granddaughter who would it mean who would go out on Child Health Plus? Would the granddaughter then end up paying nothing or paying $45 or whatever the maximum is per month on the
and
Child Health?
that just brings up the whole thing. I mean, merging all of these little pieces of the puzzle together is so important because health insurance is tied to your tax return. And then of course we have a division at EG Tax called EG Health Connect, and that's we just love to help people with that as well.
Right, and that's any age from 0 to 110.
And
We
then
can help you with any type of health insurance.
October open enrollment begins.
In October starts open enrollment for seniors for Medicare and also for the New York State,
Open
Marketplace.
But the other thing is, people think that it's only open enrollment that you can enroll. That's not really true necessarily. If you have a life-changing situation, now that doesn't mean that the world shook and everything, but I mean, let's say, for instance, your spouse passed away, right?
Yep.
Or you lost your job, or you got a job. All of those kind of situations will allow you to basically enroll for a change in the health insurance, and it doesn't have to be open enrollment.
Right. And we got to take a hard break for the news
Okay,
right
for
now.
the news, I'm Esther Golias, the tax lady. We'll talk to you on the other side. I'm Esther Golias, the tax lady from EG Tax. This is Ask the Tax Lady, our weekly radio show from 3 to 4 on WBEN. I'm joined in studio with Tiffany Fabian, Christopher Fabian. This week, we are not taking your live phone-ins. We are chewing up emails. With this, I think we've only done 3. We've done a lot of gabbing in between. But by the way, if you ever have tax questions, you can call us and we'll answer it over the phone for you. But you can also email us. And if you email us, then it's fair game to share your question on air, and that's what we're doing this week. And so, Chris, Tiff, what do we got next?
I've got Lucy from Depew, EG Tax. I want to start a small business. I was thinking a food truck might be a great first step in becoming an entrepreneur. With summer winding down, can you give me some pointers for next year? What to look for? I have approximately $10,000 to invest. Wow.
Okay.
Lots of
Well, I
planning.
mean, starting a small business really isn't as complicated as you might think, but it does require that you do certain things that have to be filed. Like, for instance, you have to get a New York State sales tax number.
Yep.
Because when you're selling food in a food truck or many of the things that are taxable in New York State, you have to make sure that you have a New York State sales tax, and you can come in to EG Tax. We'll be very happy to help you with that. Then the next thing you have to do is think about what form you want your business to take. And you guys know what I'm talking about: sole proprietorship, partnership, limited liability company, a corporation. So that would be the next thing. And really, I'd suggest that you maybe at least call us on the phone so we can explain the different things. But the least I would do would be a limited liability company. Wouldn't you guys agree with that?
Definitely, you want to make sure you're, especially if you're dealing with food in the public, you want to make sure you're protected.
On a truck?
Yep, yep. You want to make sure you're protected in an
Right.
LLC.
So a limited liability company protects your other assets, provided that you're doing everything right and you haven't been poisoning people because you want to. So assuming you're doing everything right, if you've got a limited liability company, it protects your other assets. If you just go ahead and do a Schedule C, which is a sole proprietorship without that LLC designation, then that means that in case you get audited, they can go after your other assets. So I would definitely look at doing an LLC. How hard is that to do, you guys?
Not hard at all.
At all.
Not
right?
hard at all.
And then if she or he is going to have employees, then that opens up kind of another can of worms, because then you have to have workers' comp, right?
Yep, and that's what I was going to
Go on.
say is I have clients who do food trucks or who have booths at fairs and events, and the Department of Labor actually goes to these events, and they will walk into a booth and say, is this person on your payroll? Is it, how come they're not listed? Where's their app? Where's their paper? And if you don't have it, they will kick that person out, and they're not allowed back in, and you will get fined. So you got to make sure you have every avenue covered, not just the insurance, not just the sales tax, but it's your employees, like Esther was just saying too.
Yeah, because when you have an employee, you have to make sure that you comply to certain things. You have to have the workers' comp, and you have to make sure that you have all of their payroll records, that that they fill out a W-4, that they have an application on file, and those are things that that the state requires. But when you come in to see us, or if you call us, we can hook you up. New York State has a great section on their webpage that talks about issues of self-employed people, things that you want to make sure that you look at. But after you do those things, pretty much it's just the course of operating a business. And the most important thing I can say is you want to make sure that you don't overcommit to expenses, because that's how you go bankrupt and close your business.
And then I also want to say bookkeeping is really, really important
Right.
for this new business owner. So, Esther, you taught me a long time, money in, money out. And so make sure you keep.
You want to have less money out than money coming in. That's called the
right.
net profit.
Yep.
Because obviously, if you're making money, that's a good thing.
Yep.
If you're losing money, you really want to stop the hemorrhaging. Last night, I was with a gentleman who brought some paperwork from this company that he's thinking of becoming involved in, and the company grosses $12 million a year. After their cost of goods sold and their other operating expenses, they spend $12 million a year. So they make nothing. So I said, well, you have to understand this company is not making any money. But then again, you got Tesla, who's not making any money, but they have people that are shareholders that are footing the bills. But if you're getting involved as an employee in this kind of a situation, you have to know that if the company isn't making money, eventually, without an investor stepping up and paying the bills, it's not going to stay in business. So that's something you have to think about.
Right. And, Tiff said money in. How many times do we see where people may not get money for doing a job, but they may get a dental work done on their kids' teeth in place of something, or maybe landscaping done? That counts. If you're trading services, that counts as your income too.
I was wondering where you were going with that. In other words, if the dentist says, you do my bookkeeping and I'll do your kids' braces, and the braces are worth $4,000 and the bookkeeping's worth $4,000, then it's income to both of them,
Correct.
right?
Yep.
Okay. All right. Anything else? We got another question here?
Yep. I started flipping houses last year. I bought 4 and sold 2 in 2018. And so far in 2019, I bought 3 and sold 3. My friend did my taxes and put the sales on a Form 4797. Is this correct? This is my main source of income.
Well, I don't think so. It sounds like a self-employed situation. You put things on a 4797 if you're not in the business of flipping property, and you had the sale of a depreciable asset, which the houses would be. But this sounds like he's having more like an inventory. He's stockpiling houses, putting money in. He's got a cost basis, and it sounds like he's self-employed. I mean, you can't really render a decision by just a little question like this. What I'd suggest this person do is call us, and let's make sure that he is self-employed, but he certainly sounds like. Would you guys agree?
Yeah, I would, and because it says this is my main source of income. And then I guess this is a good time to say, don't forget the new business credit, the pass-through where he would get
The QBI,
the 20%,
20% of the net
profit. And so there's a lot of things written in the new tax code to help business owners, and so really he should sit down and make sure he's the right entity. And if he isn't, we could amend the return and make the changes that are needed and put it on a Schedule C. So that's where you just really want to sit down and make sure that it was done right. I know yesterday I had a consultation come in, and there was a stock sale and it wasn't entered in the right place. We amended the return, and he got a couple of $1,000s back. So you really want to make sure that the right forms are used.
And that's exactly well. And the thing is, if last year it's determined that he really was self-employed, we can amend the return. Now, it's probably not going to be a happy day for him at all, because if he has a net profit right now, he was able to take that net profit using the Schedule C and make it a lot less taxable. But I mean, not Schedule C, on the Schedule D. But if he is self-employed, then he's going to have to pay FICA and income tax on this. But it's the right thing to do.
Right,
but it gives him the opportunity to do a pension plan.
Wow, our minds
and
are
then
right on
I
the
was going to
same.
talk about if he paid his own health insurance, he could deduct
Right.
that as an adjustment to income. So,
Right. So being self-employed gives you a lot of options. And if you were doing a defined benefit plan, for instance, you could put a lot of money, or a solo 401k plan. You could put really $45,000 away into your solo 401k plan. So there's things you can do as a self-employed person, and it all works.
Right. And that's why we love these shows, because we can go into so many different aspects of the question that we normally don't on a regular call-in week.
Right. All right. And what else we got, Chris?
EG Tax. Carolyn from OP says, my mother had just given us a deed to her house because she's worried about a nursing home taking all of her assets. The house is worth approximately $125,000, so it is the biggest asset that she has. She wants to live there as long as she can. She's 65, excellent health. If she should pass and we sold our house, would we pay taxes? My brother is also on the deed.
Okay, so what would you suggest that Carolyn do, you guys?
Life estate.
I would say stop, rewind, and play again, because she made a mistake.
Right.
She should do, like Tiff said, a life estate, which would give her the life usage of the house, the control of the house.
So if Carolyn and her brother give the house back to mom, who obviously has been living there more than 2 years, right? Then mom reverts back to as the owner. Then mom and the kids would march off to the attorney's office, and the attorney would do a life estate. Now, why is that work better for mom and Carolyn and her brother?
Because what happened now, when she deeded it over to the kids, she essentially gifted it to them. And so when you gift somebody an asset, it goes back to the original basis. So her gifting her son and her daughter the house, it goes back to the original basis. If it was partly owned by her husband, it would be a half stepped up basis, versus if it was a life estate, or if she received it at the time of her passing, then they get the stepped up basis, which is less of a gain, better tax consequence, probably no gain when you get the stepped up basis.
Yeah, so let's make just dollars and cents so it's easier to talk in numbers. The house is worth $125,000. Let's say mom and dad bought it for $25,000 umpteen years ago and didn't put any improvements in, just for simplicity. So if they bought it for $25,000, the house is worth $125,000, and they deeded the house to their daughter and son, then the daughter and son's basis is 25. If they sell it for 125, they have a $100,000 gain, right?
Right.
And so let's just say they're paying 20% on that, and state of New York, they're paying maybe 7%, so they owe about $27,000 in taxes. But if they had a life estate, how much would they pay?
Nothing.
Zero.
Because once mom dies, or mom and dad die, the last parent dies, they inherit the house.
Right.
And so that gets the stepped up basis.
Right.
Yep.
So
much
that's good.
better. Much better.
So that's good.
Yes.
Okay. What else we got?
Well, we got time for one fast one, I believe. Well,
Before our break?
Yep. I'm trying to find a fast email. Sorry, my bad.
I have done pretty good over the years investing. Right now, I own over $1 million in stock from a company that just.
Oh, this sounds like an easy one, Tip.
That there
Okay,
aren't
go on.
any that just got acquired by other companies, and it trades on the New York Stock Exchange. My wife passed away last year. She was co-owner with me on the stock. I want to give $15,000 apiece to each of my heirs. Will this cost me a lot of money, Peter?
So I think
Okay,
we take this
so-
on the other side of the break.
Yeah, I think we're going to have to. We're going to keep you hanging. This is our cliffhanger question, and we're going to take a short break, and we'll be back on the other side. I'm Esther Gullius, the tax lady. We're answering your emails. We'll see you on the other side. Hi, I'm Esther Gullius, the tax lady from EG Tax. We're here in studio for our last 15 minutes of our show to talk about your taxes. We're not taking phone calls this week. We will next week. We're chewing up your emails, and we just had a cliffhanger before the break about somebody who has stock that's worth $1 million that he wants to gift to his kids at $15,000 apiece. His wife just passed away. She was half owner. And so if the first thing he'd have to do is he gets a stepped up basis on her half, correct?
Right.
So using the $1 million, if his new basis would be whatever he paid, half of what he paid plus a $500,000, right?
Right. So
Did it say how much he
it
paid?
did not say how much he paid.
So
no.
let's just say that he paid zero. Okay. So then the stock would then be worth a $500,000 right now. So if he sold it, he would have to pay taxes on a $500,000 rather than $1 million. If he's gifting it to his children, he wants to make sure that they know that there is a 50% stepped up basis on all the stock that they're being gifted.
Right. Yeah, I wasn't sure if he was gifting the stock or if the stock was cashed in.
That's the only
because
trouble
it
with
was-
an email. You don't have the
Yep.
people to ask. That's
Right.
why if it is your email, Peter, call us and we'll be very happy to talk specifically about your situation because that's a wonderful problem to have.
Right,
Yeah,
and it-
go on. After you.
Because and the thing is, people always, what's the limit I can gift? What's the limit I can gift? I don't want to have the other person pay tax. First of all, the person receiving the money never pays tax at the time of the gift. It's what they do with the gift that could lead to taxable events.
Right. And actually, many gifts, if it's just money, it never is taxable.
Right.
I mean, unless they put it in the bank and it makes interest. And the only thing that's taxable is the new money.
Correct.
But that original principal, if it's after tax dollars, is never going to be taxed again.
Right. And they can give as much as they want to give. The $15,000 limit is just the gift tax return limit where you have to file a tax return.
Right. So in this case, if this guy gives $50,000 to his 10 heirs, all right, then he has to do a gift tax return, which would then adjust his unified exclusion, which upon his death would then be, he'd have to report how much he had given over the $15,000, which would be $35,000 times 10 would be $350,000, and that would adjust his unified exclusion when he passes away if he were to owe estate taxes. But unless he had one whopping estate, he's not going to owe the estate taxes then.
Yep.
So it's just the nuisance of doing an estate gift tax return.
Correct.
And then I also somewhere in here want to tie in about keeping track of your basis and that you guys, I've run into many clients who they sell stock and we have to find their basis, and it's always a really difficult task. So, you know.
And that's one of those things, we talked, I think, a couple of months ago about the importance of writing out your assets, what you paid for it, where they're located, what your passwords are, and putting it in a safe place so your heirs know. I mean, how many movie stars have we seen that are dying at 38 years old? I mean, you just don't know when the jig is up. But the most important thing is you want to make sure that your heirs know what assets you have so that they can get them. Otherwise, if an unclaimed asset goes to the state,
Right.
Well,
and you don't want that. And
No.
it's just a simple procedure. And kid, if you're a child and you know your parents have been remiss on this, have that conversation with your parents. You know, why don't we sit? And we have a great tool on our website, don't we?
We do. The letter of intent.
Right.
And I've printed that up for a lot of people.
And it seems morbid, but it really isn't. It's something that is in everybody's life, you know.
Yep.
None of us are going to get out of here any other way. So you want to make sure that you do the best for your heirs. And that letter of intent is great.
Yes.
I've got Tommy from Lockport. EG Tax. I have not filed my taxes in over 4 years. The IRS just started writing to me, and I really don't know what to do. I know I owe them over $5,000 in back taxes from 13, and I still haven't paid them. I'm totally lost. I can't afford to pay them since I'm in the middle of a divorce. I owe over $30,000 in credit card debt. I have a good job, but I'm afraid I could lose it if the IRS tries to collect. What can I do to get myself out of this mess?
Well, first of all, congratulations, Tommy, you did the first thing.
Esther.
I mean,
You're
it's
right.
admitting that you
That
need
was
some help.
Beautiful. Yep.
And we really want to help you. I was just dealing with somebody this morning on the same thing. He was a very similar situation, and he said to me, I'm sorry that I started getting involved in this because now I see how bad it is. And I said, well, would you have rather had your
don't
house
bury your head
them
in the
come in March and say, guess what? You got to get out of the house. You haven't been paying your property taxes.
Yep.
Because in this situation, this gentleman also wasn't paying his property taxes. So, but the important thing is knowledge is power
Yep. That's right.
because it helps you to get a handle on everything.
That's right. Absolutely. I mean, the best thing you taught me a long time ago. We live in a country where there's no debtor's prison. There's no harm, no foul. Just pull off the blinders and find out what the answer is. Then we can make a plan.
Right. So let's do all those returns, get them all done. Let's say that you go from owing 5 to maybe now you owe 15. Then what we do is we set up a payment program. You have all those credit card debts. Maybe you do a bankruptcy simultaneously. Obviously, the bankruptcy would probably have the credit cards forgiven if you're unable to pay. The IRS is going to get their money for sure in a bankruptcy, but there's all kinds of things you can do. And if you say, well, but I don't want to have bad credit, Tommy, you got bad credit already.
Yeah. Yeah.
Until you get rid of the debt, you're still going to have bad credit. And so, you know, that's part of what we want to help you with. And again, you want to call us. We are happy to help you. We want to help.
I helped somebody in Texas, and so the IRS was garnishing his Social Security. I did all of his back taxes, and now it's been a bite to try to get them to not garnish his Social Security. Finally, we had to do a Form 911 and get a tax advocate involved. My point is, do it now before they start ganging up on your wages. You know,
Right. But here's the thing: you knew to do a 911.
right?
Somebody at home who doesn't know what to do, and this guy this morning that I was talking to, he has no direction and he feels like a lost puppy. And that's, you know, we want to help you.
Right.
And so if worse comes to worse, and you don't have to pay us. I mean, this is part of what we do. We will help you answer the question. We'll make some phone calls for you. Unless we do work for you, there is no charge. So if you're lost or you have a family member that's behind the 8 ball or you get a notice that they're going to sell your house at REM foreclosure, I mean, call us. We will help.
That's
Yep.
right.
I'm not going to pay your property taxes, but we're going to help you with everything. Right?
Okay, George writes in, EG Tax. I was at my bank applying for a home equity loan, and the banker said that I cannot deduct the interest I pay on it on my taxes anymore. When did this start? I did this 10 years ago when I did my first addition to my house. Now I'm adding an in-law suite. The bank was going to lend me the money at 5% for 15 years. Is there another way to pay for this?
Liar, liar, pants on fire, right?
Yep.
because it is still deductible.
Right. If he has a room to itemize, yes.
Right. I mean, if he's an itemizing taxpayer, the home equity interest is still deductible, provided it's tied to the equity in your house and you're not upside down in equity, that you're not taking the money out that you're not taking more than your equity out.
Right.
So,
or you're paying off your charge cards, or
Right.
your yep.
right. But in this case, he's building an addition onto his personal home for his mother-in-law. So it is going to be deductible if he itemizes. And so, yeah.
And that ties me to another point, is even if he did use that money to pay credit card debts and it wasn't deductible on the federal, it could still be deductible on the
On
state.
New York State.
Because I amended somebody's return yesterday who had a brokerage fee that they charged of $7,000. She was a single taxpayer, and when I was amending something else, I added that to the New York State itemized deduction because it was missed originally. So there's room on New York if there's something you can't itemize on the
Right,
federal.
and it's not obviously as beneficial as the federal, but, $2,000 times 7%, right? $140. You wouldn't let somebody steal $140 from you, right?
Nope.
So, okay, we got room for another one?
One more. Tax lady, I just hit the lottery. I won over $75,000 and don't know what will happen at tax time. I'm pretty young, 45, and single. I don't own a house and work at a steady job making $80,000. I heard my gambling losses would offset this lottery money. Should I go lose it? Help.
If he, who's this guy, Jason?
Yes.
All right, well, Jason, give me your money then, and I'll put it in an investment for you and pay the
don't lose
taxes,
it.
because you don't go lose the money. That would be pretty stupid. But however, if you are a
Put more into
gambler
his
and you
401k.
did have lottery winnings of 75 and you did lose it, the $75,000 in income is income. The $75,000 in expense for the lottery losses would be an expense, and so technically you wouldn't pay any taxes on it. But who would lose money to save taxes? Because if you're in the 10% bracket, on the $75,000, you're only going to pay $7,500 in taxes. Nobody would lose $75,000 to save.
What I would do is he should go to his HR and put more into his 401k.
Absolutely. Buy a house.
Put some money
Don't
into
don't go to the casino. Set aside the
HSA.
tax. Give us a call. We'll tell you how much you need to set aside. Maybe make an estimate. Send the money to the federal. Send it to New York State so the money's in there, and go do something good with that money.
Yeah,
Right.
absolutely.
Right.
Paying taxes is not the worst thing.
And if you want to learn
Being
how not,
stupid is the worst thing.
if you want to learn how not to pay taxes, come to
People
our
come
tax
school.
Right.
Yes, sir.
Give us a call during the week, 632-7886. Go to our website, and we will get you registered for school.
All right. I'm Esther Gullius, the tax lady from EG Tax. If you need the best tax help, certainly you can see that we love you. We think of you as family. Until next week, I'm Esther Gullius with Tiffany Fabian and Christopher Fabian. Have a great week.